The Silver Apocalypse, How the 245 Gap Just Broke the Global Market Forever, December 27, 2024. 11:47 p.m. Eastern. A single screenshot appeared in a private metals trading group that changed everything. A withdrawal slip from a Shanghai vault, 300 kilograms gone. Physical silver leaving Chinese warehouses at a pace nobody had ever seen before. Within 90 seconds, 47 more screenshots flooded private channels. Different vaults, different amounts, same message. The physical world was divorcing the paper world forever. When New York traders woke up Friday morning, the landscape had shifted permanently. Shanghai opened trading at $81.99 per ounce. New York futures were stuck at $79.54. That 245 gap isn't a pricing anomaly. It's not temporary arbitrage. It's the sound of a 50-year system breaking in real time. It's physical reality screaming that paper promises have lost all connection to actual metal. If you've been watching this market, if you understand what silver shortage means for the global economy, you're living through the most important commodity crisis in modern history. What happened this week wasn't just another rally. It was a strategic move by the world's largest industrial economy to secure physical supply before global shortage becomes global catastrophe. China just made a decision that will echo through financial markets for the next decade. And most people won't realize what happened until the metal is already gone and the price is in triple digits. Let me show you exactly what's happening, why the 245 gap is actually conservative, and why the next 30 days will determine whether paper silver survives or becomes a historical footnote. The export ban that changed everything. To understand why silver just broke permanently, you need to understand what China announced on November 12, 2024. It wasn't just another policy change. It was economic warfare disguised as industrial planning. Starting January 1st, 2025, just 5 days from now, all Chinese silver exports will require explicit government approval through a new licensing system. Only state-approved companies producing more than 80 metric tons annually will even qualify to apply. Smaller refiners, private dealers, international trading houses, all shut out permanently. Most Western analysts dismiss this as routine bureaucracy. They completely miss the nuclear implications. China doesn't just produce silver, they control 60 to 70% of global refining capacity. When Mexican mining companies extract silver ore, they don't have infrastructure to refine it into investment-grade bars. They ship raw concentrate to China. When Peruvian operations pull silver as a byproduct of copper mining, same thing. Off to Chinese smelters. Even American mining operations send raw material to China because Western refining capacity was deliberately offshored over 3 decades to cut costs. China sits at the choke point. They're not just a producer, they're the processor, they're the gatekeeper. And on January 1st, they're closing the gate. This means every industrial user of silver on planet Earth just realized they have 5 days to secure supply before competing for scraps. Samsung needs silver for circuit boards. They can't substitute it. Electrical conductivity is irreplaceable. Tesla needs it for battery technology. Solar companies need it for photovoltaic cells. These aren't optional purchases. These are mission-critical inputs. Silver is silver. You either have it or your production line stops. When Beijing announced the export ban, procurement managers at every major tech company made the same calculation simultaneously. Buy now. Buy everything available. Buy at any price. Because waiting until January means competing for crumbs while your competitor who secured supply keeps shipping products. The scramble began immediately. Shanghai prices started climbing violently, from $68 in mid-November to $73 by Thanksgiving, then $76, then $79. By Christmas Eve, physical silver in Shanghai closed at $78.49. But that wasn't the peak. In the physical dealer network, bars were changing hands at $81. By yesterday, premiums had exploded further, $81.99 on the Shanghai exchange. But walk into a dealer in Shenzhen or Beijing, and you're looking at $84 to $85 per ounce for immediate delivery. The premium over COMEX had blown out to over $8. Let me give you context for how insane that is. Normal market conditions. Shanghai trades at a 20 to 50 cent premium over New York. That's logistics cost and local demand. A $1 premium is considered tight. A $2 premium is a warning sign. $8 is market dislocation that hasn't occurred since 1980 when the Hunt brothers tried to corner silver and it hit 50 per ounce. But here's what should terrify every paper trader. That 8 premium should have disappeared within hours through basic arbitrage. Smart money buys cheap metal in New York, ships it to Shanghai, sells for profit. Price gap closes. Economics 101. Except it's not closing, it's widening, because you can't ship metal that doesn't exist. While everyone's watching the silver premiums in Shanghai, they're missing the real bombshell. The crisis isn't over there, it's right here, inside the COMEX vaults. And what I'm about to tell you should frankly be terrifying for anyone who believes in a fair market. COMEX tracks silver in 2 ways: registered and eligible. This difference is absolutely critical. Registered silver is what's actually available for delivery if you cash in a futures contract. It's the for sale pile. Eligible silver is different. It's just customer metal being stored in a COMEX warehouse, like a giant safe deposit box. It's not for sale. So, back in 2020, COMEX had over 200 million ounces of registered silver. A nice, healthy cushion. But fast forward to today, that number has plummeted to under 70 million ounces. That's a staggering 73% collapse in just 5 years. But wait, it gets much, much worse. Even that 70 million ounce number is a lie, because in the first 4 trading days of December alone, a mind-blowing 47.6 million ounces were claimed for physical delivery. Think about that. That's 68% of the entire available inventory wiped out in just 96 hours. This is the whole point of a futures market, right? If you hold a contract, you should be able to get your physical metal. But what happens when the majority of the metal is claimed in less than a week? What happens when January contracts come due? The numbers just don't add up. There isn't enough silver to go around if even a small fraction of contract holders demand what's rightfully theirs. COMEX knows they're in trouble, so what did they do? They started playing shell games with the numbers. On December 19th, JP Morgan, the biggest vault operator, magically moved 13.4 million ounces from the registered category to the eligible category. They took silver that was supposed to be for sale and reclassified it as not for sale. So, on paper, the headlines can say, COMEX holds 451 million ounces, nothing to see here. But that's a dangerous deception. Nearly 400 million of that is just customer storage. The real deliverable supply is collapsing in real time. If this were a bank, we'd call it a bank run. And that's exactly what this is, a silver bank run. People are screaming, I don't want your paper promise anymore. I want my metal. And the vault is basically saying, we're going to need a minute. Now let's compare this chaos to Shanghai. Their visible inventory is much lower, around 39 million ounces. But here's the crucial difference. In Shanghai, what you see is what you get. When a silver bar enters their vault, it's real, it's there, and it's available. It's not part of some complex paper game. Chinese dealers report that the standard 15-kilogram industrial bars sell out within hours of arriving. There's no buffer. Every single ounce is immediately bought up by electronics giants, solar companies, or smart investors. Their inventory is low because physical demand is through the roof. That's a real market signal, telling you the price should be higher. So which market makes more sense to you? The one that admits it has 39 million ounces and prices it accordingly, or the one that claims 451 million but can't deliver it? This is exactly why Shanghai trades at a premium. Their price reflects physical reality. New York's price reflects a paper fantasy. What makes this situation completely different from past silver rallies is the source of demand. Back in 1980, it was the Hunt brothers using leverage. In 2011, it was investors piling into ETFs. Both were driven by financial speculation. This time is different. This is an industrial demand tsunami. We're talking about a real, physical shortage, and industrial demand is what economists call inelastic. When a hedge fund buys silver, they sell when the price goes up a few dollars. But when a company like Samsung or Tesla buys silver, they're not speculating. They need it to build their products. If silver goes up $5 an ounce, they don't care. They pay it, because shutting down a production line costs them millions of dollars a day. That extra cost is a rounding error on a $1,200 phone. They have no choice but to pay up. This creates a constantly rising floor under the silver price. Every time the price dips, industrial buying programs automatically kick in. These aren't emotional traders. These are computers programmed by CFOs who see the supply deficit, see China hoarding its own production, and know that $100 silver is a matter of when, not if. They are buying every dip they can because they'd much rather pay $80 today than $120 tomorrow. The numbers are staggering. Global mine production is approximately 835 million ounces per year, but total demand this year? 1.08 billion ounces. That's a deficit of 245 million ounces annually. We've been running deficits for 5 consecutive years now, adding up to a cumulative shortfall of over 1.2 billion ounces. So, where did all that silver go? It came from the above-ground stockpiles and inventories that were accumulated over decades. The problem is, those inventories are now hitting critical lows. Just look at the demand. Solar panel production alone consumes over 230 million ounces every year, and that's growing at 15% annually. Electric vehicles use silver in their battery management systems. 5G networks need it for circuit boards. AI data centers use it in high-performance servers. The entire fourth industrial revolution is being built on a foundation of silver, and we're simply running out. This isn't just about commodity markets anymore, this is economic warfare. Eastern powers see the massive renewable energy build-out that every government has committed to. They know it requires enormous amounts of silver, so whoever controls the silver controls the energy transition. They're not restricting exports just for investment returns. They're doing it because they've run the numbers. Their own domestic solar industry needs every single ounce they can produce. Their EV industry needs it. Their electronics manufacturing needs it. If they keep exporting silver to the West, they'll end up short themselves. So they're keeping it. They're willing to pay $80 for it domestically instead of importing it at $90 because they know that in 12 months the global price could be $150 and there might not be any metal available at any price. Western powers see this too. In November, the federal government declared silver a critical mineral, putting it in the same category as lithium and rare earth elements. It's now a national security priority. Defense departments need silver for military electronics. Energy departments need it for the renewable build-out. But here's the problem. Western nations don't have significant domestic refining capacity. They shut down their smelters decades ago and outsourced all of that to Eastern refineries. Now, they're in a vulnerable position where a critical mineral essential for national security is controlled by strategic competitors. European nations are scrambling to reopen old mines, but mining takes years. You have to get environmental permits, develop infrastructure, and train a workforce. You can't just flip a switch and double production overnight. The geological reality is we're running out of easy-to-get silver. Ore grades are declining, mines are getting deeper, and energy costs are rising. This puts the major commodity exchange in a nightmare scenario. If they do nothing, prices will likely shoot into the triple digits because industrial demand is inelastic and the supply is falling. If they try to manipulate prices down using margin hikes or trading halts, they'll just accelerate the decoupling from Eastern markets. We've seen this playbook before. In 1980, when wealthy Texas brothers drove silver to $50, the exchange implemented liquidation-only trading. You could sell, but you couldn't buy. It killed the rally overnight. In 2011, they raised margin requirements 5 times in 9 days, an 84% increase, which forced liquidation and crashed prices from 49 down to 33 in a week. But 2024 is not 1980 or 2011. Those rallies were driven by speculation. There was no real physical shortage. The exchange vaults were full. When they killed the paper speculation, prices collapsed because the fundamentals just didn't support them. This time there is a real physical shortage. Raising margins doesn't create more silver. It doesn't help major phone manufacturers build their devices. It doesn't put metal back in Eastern vaults. It just proves that the paper market has lost touch with reality. If Western exchanges try these manipulation tactics again, Eastern markets will simply ignore them. European markets will find a way around them. Industrial buyers will bypass the Western exchanges entirely and deal directly with Eastern smelters, Latin American miners, or regional refiners. The exchange will become a zombie institution, trading paper contracts that nobody honors while the real world moves real metal at real prices. So here's what I'm watching for next week. On Monday, if Eastern markets open above $85, it's a signal that Asian buyers are in full panic mode. If Western exchanges gap up to match, that confirms the decoupling is accelerating. If registered inventory drops below 60 million ounces, that's the final warning before the system breaks. And if we see announcements of position limits or trading halts, that's pure desperation, the exchange admitting they've lost control. My conservative estimate is $87 by Monday morning in Western markets. The aggressive estimate is $92. But if Eastern exchanges hit 95 while Western markets are stuck at 85, that's a $10 premium. At that point, even the mainstream media won't be able to ignore it. Once retail gets involved, momentum chasers and crypto investors sitting in cash, we're looking at a vertical move. $110 by mid-January, $130 by February. But zoom out further. This isn't just about price. Silver is the linchpin of the energy transition. You cannot build solar panels without it. Every panel uses 20 to 40 grams. Multiply that by the billions of panels being installed globally, and that's over 230 million ounces annually just from solar. The entire renewable energy build-out that every government has committed to requires silver. This is a resource war, and China just made the first major move. So who wins and who loses in this scenario? Industrial users who secured their supply win. Companies that bought 6 months of inventory at $70 while their competitors waited for better prices will dominate their markets as the shortage intensifies. Physical silver holders win massively. People who accumulated metal below $80 will watch paper currencies become worth less against real assets. You see, silver isn't just an investment, it's money. It has been money for 5,000 years. You can't print it or create it from thin air. China wins strategically. They control the refining capacity and are keeping the metal for their own domestic use. They'll dominate the energy transition while the West scrambles for scraps. On the losing side, COMEX paper traders lose everything. Anyone holding short positions faces infinite losses as industrial demand creates a rising floor. Anyone trusting paper promises over physical metal will learn the hard difference when delivery fails. Western governments lose strategic control. A critical mineral dependency on China becomes a national security nightmare. The Pentagon needs silver for military electronics, but relies on Chinese refiners for its supply. Most importantly, anyone waiting for confirmation loses the opportunity. By the time the mainstream media catches on, by the time your neighbor starts talking about the silver shortage, by the time the price is in triple digits, the metal is gone, and you're paying nosebleed premiums for scraps. This brings us to the final choice. You have a decision to make right now. You can believe COMEX paper prices and assume silver is fairly valued at $79. You can trust financial media telling you this is just another commodity rally that will reverse. You can wait for Bloomberg and CNBC confirmation before acting. Or you can believe Shanghai physical prices, which are showing we're already north of $82 with a clear trajectory toward triple digits. You can believe the vault data showing registered inventory collapsing. You can believe industrial demand data showing deficits stretching years into the future. You can act now while metal is still available, while premiums are only a few dollars over spot, while the crowd is still skeptical. Or you can wait for mainstream confirmation when prices are in the triple digits and physical premiums are $20 or more. The institutions already know. JP Morgan didn't accumulate 750 million ounces because they think prices are going down. China isn't restricting exports because they're worried about an oversupply. Central banks in Russia, India, and Poland aren't adding silver to their reserves by accident. They know. The question is, do you? This weekend, ignore the noise. Ignore the analysts who will tell you this rally is overextended. They're using outdated models that assume supply and demand curves are elastic, that assume China won't change the rules, that assume paper markets always function. Those models are broken. The world changed this month. Look at what's actually happening. Vaults are draining, premiums are exploding, export bans are coming, and industrial demand is inelastic. Those are facts, and they are all pointing in one direction. The price is going higher not because of speculation, but because of scarcity. 1 ounce of silver is 1 ounce of silver. What's changing is how many paper dollars you need to exchange for that 1 ounce. And the trend is clear: more paper, less metal. That ratio will keep moving in favor of the metal until either demand crashes, which it won't because it's industrial, or supply surges, which it can't because of geology. So the price adjusts. It has to. It's just math. If you found this breakdown valuable, subscribe right now. The next 72 hours are critical. You want to be informed, ahead of the curve, not chasing headlines after the move has already happened. Stay sharp. Trust the data, not the narrative. Remember, the physical market doesn't lie. Paper can be manipulated, prices can be managed, and headlines can be spun. But metal is metal, and metal is becoming the most valuable substance on the planet. The silver apocalypse has begun. The question isn't whether you'll participate. The question is whether you'll be positioned before or after the crowd figures it out. This is just the beginning.